think still a lot of people think of Latin America as being basically a commodity story with a little bit of something else. But I was listening to Nick speak. I mean, I think that what we're focusing on our Latin American funds is a very similar story to what he was talking about in India, which is one of a domestic growth. Everybody's seen these demographic charts in the past showing that we have a very young population, and it's part of the reason why you want to invest in emerging markets, because you have this young population that's growing. It's the consumer of the future. But for Latin America, there has always been the case that this is always a promise, and we were never getting there. You didn't have the purchasing power. You had very high inflation rates, and then you had very, very high interest rates. And interest rates in Brazil, for example, are still amongst the highest in the world, but they're 8.75%, which is the lowest you've seen in over 60 years. It's the first time that we've had a nominal rate in the single digits there. And that's having a very powerful impact in the economy overall, in the consumption patterns, in the ability to consume. And with that, we don't only have this young and growing population, but you also have them now becoming more and more active consumers, and that opens up a lot of different opportunities for us as investors. And what we've seen over the last 5 years is through about 120 IPOs in the Brazilian market, the concentration in the very important Petrobras, Vale, steel stocks, pulp and paper stocks has come down. They're still very important and much more important in the stock market than they are in the economy overall. But the growth in the banking system and the consumer stocks and home builders, healthcare, technology, all these sectors that really were small or non-existent 5, 10 years ago now are becoming more and more part of what we're investing in and what we're focusing on. When we think about Latin America, I think part of the reason why we had a strong outperformance over the last decade is that we didn't have as much damage done by the slowdown in the global economy over the last couple of years. And the main reason for that is that when we look at Brazil, which is, again, the biggest country in the region, it's one of the countries that's least impacted by global activity. If you look at this graph, which is from 2008, it shows that exports as a percentage of GDP was only 14%. And that number came down to 11% in 2009. So exports are important when you're talking about 10% of your economy. If it drops 20, 30%, that's obviously going to have a negative impact, and that's what we saw last year when GDP got closer to zero. It was really because of this export component slowed down quite a bit. The domestic economy actually continued to do fairly well. But because you have this lower dependency on overall global activity, and you have this very strong fundamental story on the domestic side, Brazil really was affected by the crisis in November of 08, and by March of 09, we're already seeing positive job creation. And actually 2009 was one of the best years in terms of new jobs being created in the economy, and these are higher paying jobs, which then lead us to the next graph, which is the growth in Brazil's middle class. One of the reasons why we're very calm about the election coming up in October is that because of this history over the last 10 years of an improvement in the middle class, improvement in the purchasing power of the average Brazilian doing much better, having a better job, better educated, it's almost impossible for any politician to try to come up with a reasonable reason why you would see a change in economic policies. Going back to when I visited my grandparents when I was in college, and my grandfather had to call the bank every day to see what the overnight rate was because inflation was 2-3% a day. It's a very different environment from today, where you have a central bank that's going to start raising rates next month because the decimal point of the annual inflation rate is too high. So instead of 4.5%, we're getting closer to 5%, or maybe just over 5% as an annual rate. And this allows people to be a lot more efficient in their investments. CapEx programs now are a major focus for CFOs, while before they were just trying to make sure that the balance sheet didn't blow them up. And I think so it's a much different environment to be investing in. And the fact that you have now 2/3 of Brazil's population being C-class or better really makes this a true middle-class economy with a lot of opportunities for us. And then last but not least, you also have all these events happening over the next decade, which are going to have a major impact on the economy. You have the World Cup in 2014. So after we win in a couple months in South Africa, we'll be going for our 7th championship here at home. You're going to have the Olympics in 2016, and I'm not sure that we're going to do what the Canadians did in the Winter Olympics in terms of winning a lot of medals, but we'll be there. But with all this, there's a lot of investments going on. The World Cup is actually more important than the Olympics. It's 10 cities that are going to have to get ready. It's airports, it's urban transportation, it's hotels. If you go to Rio today, after your top 2 or 3 hotels, you don't really have the hotel infrastructure that you would think a city like Rio should have. But with the investments they're going to have to make for the Olympics and for the World Cup, Brazil should be able to become a better tourist destination and have another source of income, which is fairly small right now. Overall, over the next 5 years, we're talking about $400 billion of infrastructure investments in Brazil. Half of it coming from Petrobras and all the investments they're making in the pre-salt area. And this is obviously very important. It's going to change the way Brazil is as a player in the oil place. And Robin can talk more about that maybe in the next section. But the other half is domestic stuff. It's stadiums, it's airports, it's roads, it's all kinds of things. It's hydroelectric plants in northern Brazil. And these are obviously job creating and good for the economy overall. And so it puts an additional boost to the overall economic growth that we're seeing from a domestic consumption standpoint. Last but not least, we don't have a slide here, but Brazil is still one of the cheaper markets out there other than what Sam's going to talk about. But earnings growth, it's on the upswing. We're talking about earnings growth now of about 40% for 2010, with the country trading at a P of around 12 times. A lot of the pushback that we get is that Brazil is expensive now because you're used to having the Brazilian market trading a single-digit PE. But I think the risks have changed quite a bit over the last decade. We got a chance to prove our case with the recent financial crisis. So there's no reason in my mind why Brazil should continue to trade in the bottom half of valuations. So you have this great top-down story, you have the valuation supporting, and this is why we continue to be very positive Brazil, and I hope you vote for us at the end here. Thank you very much.